Welcome to the Deep Dive. Today we are digging into the Lument Finance Trust, ticker LFT, and their Q3 2025 earnings call.
Yeah, this one happened pre-market on November 13th, and the market's reaction was pretty rough.
It was. And our mission today is to figure out if this is a company in real trouble or if it's just taking some necessary pain to set up in a much brighter future.
Exactly. They're trying this huge pivot, away from a messy, low-leverage model toward a much cleaner, multifamily lending machine. The question is, can they pull it off?
And to really understand that pivot, we have to start with just how brutal these Q3 results were. I mean, this was an earnings trough.
Oh, absolutely. Let's not mince words here. This was a dramatic miss. Distributable earnings per share, which is really what everyone watches, came in at just 2 cents.
2 cents. The street was at, what, 7.5 cents?
7.5. So they missed by over 70%. I mean, year over year, earnings power just got decimated. JAP EPS was basically zero at a penny.
And when you see an earnings number that bad, you immediately look at the revenue. For a company like this, that's net interest income, or NII.
And NII plunged.
It really did.
Fell to $5.1 million. The consensus was looking for something like $8.3 million. So a 38% miss there, too.
Management was pretty direct about why, though. They pointed to two things.
Right. Portfolio paydowns, so fewer loans earning interest. But the real red flag was the other piece.
The interest reversals.
Yeah, about $800,000 from interest reversals and non-accruals. And for anyone listening, a non-accrual loan it's a big deal.
It's income you thought you had in the bank, right? You've booked it. And then suddenly the borrower stops paying and you have to just erase it. It's vanished income.
It's a huge signal about credit quality. And that weak earnings number, of course, led straight to the dividend dilemma. They had to cut it.
They slashed it down to 4 cents a share from 6 cents.
But even with that cut, their distributable earnings of 2 cents only cover that new 4-cent dividend by half.
So they're still not covering it. They're paying out more than they're earning, even after a cut.
It's like paying your rent with a promise that next month will be better. They're basically buying time.
The one bit of good news, or stable news, I guess, was the book value.
Right. That held pretty steady, slipped just a tiny bit, holding at $3.25 per share. And that number, that book value, is kind of the anchor for their whole story right now.
Okay, so that stability is important, but it makes you ask what kind of asset cleanup was happening behind the scenes to drive that terrible earnings number.
That's where we get into the nitty-gritty of the call. The CEO's tone was, he admitted it was earnings light and below plan. He made it really clear the focus right now is asset management and liquidity, not growth.
They're hitting the pause button to clean house.
Exactly. And the house is mostly multifamily, almost 90% of the portfolio. And importantly, zero exposure to the really scary stuff like office or retail.
That's a huge positive. But even in multifamily, they're not immune to problems.
Not at all. We learned that 7 loans, which is about 10% of their total unpaid principal balance, are now risk-rated 5.
And 5 is the worst rating you can get.
It's the worst. It means default is imminent or has already happened. And on top of that, they're now landlords for properties they didn't want.
The REO, real estate owned.
Correct. 4 multifamily properties that they've taken back with a carrying value of $58 million. And the challenge is, those properties are only 73.5% occupied on average. They're bleeding cash.
So when management says they're comfortable with the current risk ratings and don't see more downgrades coming, I mean, why should an investor believe that?
That is the ultimate test, isn't it? It's a bet on their transparency. Their argument is that these are all legacy problems from loans they wrote back in 2021 under totally different assumptions.
So they're saying we've ring-fenced the problem.
Yes. But if another problem loan pops up next quarter, all that credibility goes out the window. The market will be brutal.
And what's the plan for these REO properties they're stuck with? They can't just sit on them.
No, they have a specific plan. They figure it'll take 3 to 6 months of, hands-on work fixing things, getting new tenants, stabilizing the operations. Then they can look to sell or refinance. It's not a fire sale.
And this is a key point for shareholders, right? If they do that work and sell a property for more than its carrying value,
that profit goes directly to the common shareholders. It's a direct way to rebuild that value and prove the model works. A single successful sale would be a huge confidence booster.
Okay, so that potential upside from cleaning up the old mess, that leads us to the constructive part of the call, the path forward. the strategic financing pivot.
This is where it gets really interesting. This is the whole mechanism they're going to use to rebuild that NII number we talked about.
It starts with a huge lifeline from a major bank.
A huge one. They secured a new $450 million master repurchase facility with JPMorgan. It's flexible, it's long-term, and it shows a major player has confidence in their plan.
But the real genius here, the real chess move, involves an old securitization. They're redeeming their 2021 CRE CLO. Why is getting rid of an old deal so important?
It's all about trapped equity. That old CLO was incredibly inefficient. It only gave them 72% leverage.
Okay, so break that down. What does 72% leverage mean in simple terms?
It means for every dollar LFT loaned out, they had to put up 28 cents of their own shareholder equity. That is a huge amount of capital to have tied up. By redeeming it, they estimate they're freeing up $170 million of their own money.
Wow. That's a ton of cash to suddenly have available.
A ton. And they're not waiting. They immediately redeployed it into a new modern structure. They priced a new CLO, the LMNT 2025 FL3. And this one has a dramatically higher advance rate.
Higher than 72%.
Much higher, 88.1%.
So if they were putting up 28 cents on the dollar before, what does this new rate mean?
It means now they only have to put up about 12 cents of their own equity. That 16-cent difference, applied across the whole portfolio, is how you generate massive returns on equity. It's the whole ballgame.
So for you, the listener, this is the key. That jump from 72% to nearly 90% leverage, that is how they fix the 2-cent EPS problem. They're swapping out inefficient capital for highly efficient capital.
And there's a side benefit, too. All this new liquidity and flexibility helps them deal with a corporate term loan they have coming due in 2026. It gives them options.
Okay, so the financial engineering is impressive. But let's zoom out a bit. What's the broader market they're operating in?
Well, the multifamily backdrop is what management called constructive. You're seeing modest, stable rent growth, pretty strong occupancy. It's not a boom, but it's holding up.
But there's this big cloud on the horizon, the maturity wall.
Absolutely. There is a huge wave of loans from 2020 and 2021 that are all coming due in the next couple of years. And those loans were underwritten when interest rates were near zero. Refinancing them now is a major challenge for borrowers.
Which creates a huge opportunity for a bridge lender like LFT.
A perfect opportunity if they can execute their own strategy.
And despite that opportunity, the market is pricing this stock for failure.
Complete failure. It's trading at half of its book value. The market cap is tiny, down around 85 million. And the stock itself has been crushed, down over 37% in the last year, while a benchmark like the VNQ was basically flat.
That is a massive discount. But we did see a small vote of confidence after the call.
We did. The CEO and the chairman did an insider buy. About $88,000 worth of stock in late November.
Now, 88 grand isn't a life-changing amount for a CEO.
No, but it's the signal, right? They're putting their own cash on the line, telling the market, we know the numbers were bad, but we believe in the plan, and we think our stock is cheap.
So for anyone watching LFT, the catalysts over the next 6 to 12 months seem pretty clear.
Very clear. 3 things to watch. 1, how fast can they ramp up that new high-leverage CLO? 2, what happens with those REO properties? Do they sell them at a gain or a loss? And 3, what does NII do? We need to see that number start climbing again fast.
Which brings us to our final segment. We take all this analysis and boil it down into a high-risk trade idea. And remember, this is just an exercise. It is absolutely not financial advice.
Okay, let's put on the hedge fund analyst hat. Here's the pitch.
Lay it on us.
The thesis is simple. LFT's stock is priced as if the credit problems will get worse and the financing pivot will fail. But management is telling us the problems are contained and the financing fix is already done. This is a pure bet on management's ability to execute on the plan they just laid out.
A pure execution bet. So what's the outrageous but plausible trade?
You go long the equity. You're betting that the successful ramp-up of the new CLO, combined with just one successful REO sale, even a small gain, forces the market to re-rate the stock. If they can prove the new model works, that half price to book valuation gap has to close. I'm talking a 30% move.
Okay, but it's a huge if. Execution risk is everything here. So how do you protect the downside? What's the hedge?
You'd want to protect the position with a structured put option, just in case the whole market rolls over. Or for a more targeted trade, you could short a competitor, another CRE CLO player that's still stuck with an old, inefficient financing structure and doesn't have that shiny new JPM facility.
So you're making a relative value bet on LFT's superior financing.
Exactly. You're betting that their new engine lets them win the race.
So to wrap it all up, the story at LFT is this fundamental conflict. On one side, you have terrible current earnings from a deliberate cleanup. On the other, a really powerful forward-looking strategy.
The earnings trough might be in the rearview mirror, but they have to prove it. The market is not going to just take their word for it.
Which leaves us with the final question for you to think about. Can LFT complete this incredibly complex pivot from a legacy lender to a modern one before the market just gives up on them entirely? The clock is ticking.
It's a fascinating test case. High stakes.
As always, we are here to give you analysis and context, never investment advice. Thanks for joining us for this deep dive.